So everybody's really excited about real estate right now. If you look at the performance of REITs, it's up, 24% in the past 12 months. That is double the rise in the S&P. What are you seeing from the perspective of a brokerage firm? How nervous are you about the prospect of a rate hike? Is that going to cut the legs off all the enthusiasm in the asset class?
Well, I think the answer to the rate hike is we've already seen it. So in May of 13, the 10-year bond went up approximately 140 basis points in roughly 90 days, and I don't think anyone could suggest that it stalled the pricing in the markets from a real estate perspective or fundamentals of real estate. But maybe a little bit of a background there is real estate has grown up over the last 25 years as an asset class. So what we've really seen do the performance that it's had over a 15 or 20-year period, we've seen institutional investors, so state plans and endowments and corporate plans, sovereign wealth funds, increasing allocations to the space because they see it as a necessary diversifier in a well-constructed portfolio based on its performance history over the last 25 years.
So you're not bracing for an imminent slowdown in your sector because the 10-year yield's going to hit 3 or 3.5%?
The trend is your friend. Look at property sales here, this chart we have. I mean, it's pretty amazing, but not something you wouldn't have guessed, right? I mean, I think a lot of people were thinking at the middle of 2009, wow, this is really a trough here. This is the time to get in, although you had to be brave.
You had to be brave. You had to go a little counterintuitive. Well, if you think about it broadly, just real estate in general, real estate houses the U.S. economy. So in large part, commercial shopping centers or office buildings or hotels or whatever it may be. So depending upon your view of the U.S. economy, we tend to follow that. But we have longer duration leases. So typically what we're seeing is increasing allocations both in the retail space, the high net worth space, as well as the institutional investment class. And that is putting more capital into the space, which gives us more consistency on price.
So let me kind of follow up to Olivia's question about interest rates. I mean, we hear all the time, at least on the retail side, that an interest rate increase by the Fed may spur people to actually go out and make a purchase who've been on the fence because they want to get ahead of any further increases. Do you think the same holds true in commercial and institutional investment?
Matt, it's a great question. It's hard to give you any anecdotal evidence that that's the case, but it would make sense from a human nature standpoint that people would do that.
Certainly that's exactly what I did.
That's right. Olivia is now a homeowner.
Yeah, good.
Tell us a little bit more about some of the deals you've been working on. What kinds of things are you seeing?
Yeah, and you actually gather capital on the one side, right? And then you fund real estate investment or funds that want to do that on the other side.
Let me distinguish. So we do not take an investment position. So we don't take capital risk or principal risk. So we're not an investor. We're a pure intermediary. So what we do is sell assets or finance assets or raise funds to invest in real estate on behalf of institutional investors. So what we're seeing is a strong interest in the space to raise more capital. And what they found over time is if you invest in good real estate in good markets and you don't over leverage, you can.
But what parts of the country, what types of projects?
It's very geographic diverse. So across all product types, we're seeing momentum in net income, occupancy increases, and rent increases across the board. So again, shopping centers, office buildings, hotels, et cetera. So the performance of real estate in general has been good over the last 7 years, and in particularly over the last 12 to 24 months in terms of gains in occupancy and rental rate increases.
I've got a note here that says you arranged $160 million in combined financing for a dual-branded W and Element Hotel in Philadelphia, where I went to college, a city that everybody thought was, nobody could figure out why the Philadelphia real estate market hasn't done better for the past 20 or 30 years. Is Philadelphia now hot?
It would go back to job growth. So let's take a look at job growth, and let's take a look at the underlying economy of Philadelphia and what's driving the SIC code industry is driving that, and that would really determine investors' interest in Philadelphia. But generally speaking, geographically across the board, the coastal markets are clearly very, very important to institutional investors, but now they are beginning, as are foreign investors, to look at other markets based on their view of job growth.
All right. Hey, Mark, really a pleasure having you here. Mark Gibson, chairman of HFF.